afternoon, everyone, and welcome to this webinar on this lovely February afternoon. It's my pleasure to introduce our speaker for today on our topic, Balancing Today and Tomorrow Using the Two-Pot System Wisely. Our presenter today is Terence Tobin, a certified financial professional and founder of Rich Ideas Group and the director of financial planning. Terence is passionate about helping people understanding their finances and building strong futures for themselves and their children. He believes financial advice should be simple, practical, and personal. His work focuses on everyday decisions that matter, such as budgeting, savings for children's education, and planning for retirement. Thank you, Terence, for doing this webinar for us. I'm sure it's going to be quite insightful for our audience. If you have any questions, would you please post that in the chat and we will deal with it at the end of the session. Thank you, Terence. Over to you.
Thank you very much and welcome to everybody. And as Rihanna has said, today we're going to touch on the two-pot system and questions are welcome. I can't see them right now while we're doing the presentation, but we will definitely get to them at the end. I'd like you to get as much value out of our session today as possible. As you can see me, Terence Tobin, and we want to go through today, what is this two-pot system? Or is it actually a three-pot system? Or are we smoking pot? What is going on? What changed? Why did it change? What is it all about? And how does it affect you? Please remember, information I'm going to share with you today, purely information, purely educational. This is not financial advice directed at any person individually. And I would recommend for your situation, please reach out to the FPI, go and visit them on the My Money 123 website. I will put the link at the end and talk to a certified financial planning professional. And you will also note I've mentioned there that rules can differ from fund to fund and your situation is personal. So I want us to focus on that you understand that we're talking in general today, but your financial planning is unique. However, for all you dedicated people that are listening today and you haven't potentially seen the budget updates and announcements, there's a nice one I just want to run past you quickly and keep you in the loop so that you know what happened. What's been announced today is that you can now, from March, from Monday next week, increase your tax-free contributions by 10,000 Rand a year. You can add another 70,000 Rand a year to your retirement savings as a tax deduction. There's been an increase in capital gains exemptions and allowances, as well as your primary residence has been increased. For us little micro businesses, there's been a nice substantial increase, and that VAT registration requirement has also increased for the first time in I don't know how many years. So here's some good news, and the ones we want to concentrate on is the top two, because that we start saving towards our future, which aligns to what I want us to get through to today. And here's a broad outline of what I want to share with you today and the value I'd like to add to your financial planning journey. With regards to the two-pot or retirement savings and how this affects you, I believe it to be more of a behavioral habit than a financial decision. And I know that you've hopefully signed up for today's webinar because you want to get a better understanding of how the changes in law can have an effect on your retirement savings and your future financial stability and income. What's important to realize is that in South Africa, and if you look around you, people you know, people you work with, family, friends, we have a massive retirement funding problem. South Africans don't invest enough for the day that they want to start drawing from their assets to provide themselves an income. And unfortunately, there's a number of reasons for that. There's a psychological reason because we can't actually associate with our future self that is 20, 30, 40 years away from today. And then there's a behavioral one of being, well, I've got time. I'll get to this. I've got more important things to focus on today. But ladies and gentlemen, the best time to start was actually yesterday. The second best time is today. And I want to run through that with you because I do understand the cost of living. We all are under tremendous pressure. Salaries are not growing at the rate of which the cost of living is increasing. So I know there's a lot of balls you have to juggle. And as a parent, I get that. We want to do the best for our children or child. I only have one. But one of those things we have to do for our children, in my belief, for my household, is I don't want to be a financial burden to my daughter. And that's why saving for my retirement is very important. So as you can see the topics on the slide, and I'm just going to have a little caveat there. I'm not a massive fan of PowerPoint. I love to talk off the cuff. So I've got a couple of slides. I'm not going to read them verbatim. I'm going to rather chat to you through them. I might bounce around a little bit, so bear with me. What I would like to get as our final outcome from today is that the best outcome we can achieve or strive for is a stable income later with fewer money emergencies today. That's what I want us to get to. So let's dive in. What is the two-pot and who does it apply to? Well, first I'm going to go with who does it apply to. The two-pot retirement system came into effect around 18 months ago on the 1st of September 2024. And for every rule, there's an exception. So the two-pot system applies to us members, and we call ourselves members, of a pension fund, a provident fund, a preservation fund, a retirement annuity fund, and some public sector funds where you are active. So you are part of that fund, your employer and or yourself are contributing to those funds, and this two-pot system applies to us. Now for every rule, there's an exclusion or special case. You might be a pensioner already. Perhaps the two-pot doesn't apply to you. What we call in the profession, old generation retirement annuity policies or legacy policies. And then if you were 55 years of age or older on the 1st of March 2021, 5 years ago, and you opt in, then the two-pot system applies, and then your closed or dormant funds and funds that are in liquidation. So to know whether you are in or not, best is the thing you can do in that situation is go and check with your fund administrator or your financial planner. As again, I say the rules could differ from fund to fund and product type to product type. So if you look on your statements that you do receive from time to time from your administrator, if you see you've got a savings component there, you know that you're a part of the two-pot system. If you don't see that, you might not be. Like I say, ask for help to get clarity and certainty. So that's who the two-pot system applies to. But what does that mean and how did it come about? So prior to the 1st of September 2024, this is how retirement fund solutions worked. The pension funds, provident funds, retirement annuity funds, preservation funds, all the ones I mentioned before. And this is a busy slide. Don't worry too much. The session is being recorded and you'll be able to watch it again in a couple of weeks' time on YouTube. But what would happen is your money would come into the pot and it's tax deductible. Meaning SARS says, thanks for funding your retirement. We'll give you a tax relief because you're doing so. Certain provisions apply in the Pension Funds Act, Regulation 28, on where we can invest your money. There is no tax on the money in this pot. All your growth, all your dividends, all your income earned, everything grows here tax-free. No one puts their hand in the pot to take any tax out. And then there's certain protection mechanisms from a creditor protection perspective. There's no estate duty on these funds, which is wonderful. So you save a considerable amount of tax when you pass away. At divorce, these things were split according to the divorce orders. Now, this retirement fund or retirement funds pre-1 September 2024, should people have left their employer, which we have from time to time because hopefully you've got career growth, new opportunities, you are able to cash out your retirement fund in full. However, there is substantial tax that is deducted from that. if you had to pass away before retirement, it would pay out, as I said, to your nominated beneficiaries. And at retirement time, which most of us have heard or know of, up to 1/3 of that money you could take in cash. Sometimes tax would apply. And then the 2/3 would be left behind to buy you an income. That's what we have had, and which does still apply. And I'm going to come to that in a moment. So again, lots of information there. I'm going to run through it again a couple of times during the presentation and looking forward to your questions. So why did we bring a two-pot system into the foray of solutions? Why did it come about? Well, when people left their employers, preservation of that money seldom occurred. And this I can tell you from real life experience as a CFP and nearly 2 decades in this profession, and colleagues and people around us, and I'm sure you've experienced this or seen it too, is when we're hit with financial pressure, when we're struck with financial hardships, often we've seen is someone will exit employment because there's a pot of money, and we believe that that pot of money will now solve our problems. And for most South Africans, if they belong to a forced retirement option like a pension fund or provident fund, and I think they are spectacular because they create that habit, all right, it's done for us before we even get our salary, that is often one of the most significant line items on a balance sheet, on their wealth creation. It is a massive asset. Second to a home, sometimes bigger than the value of one's home, if you are fortunate enough to own property. And I'll come to that in another webinar one day, but the home you live in is not actually an asset. Right, so let's come back to the two pots. So that's where we've said here, when pressure hits, people will resign and cash out because they want to rebuild or try and solve for that financial difficulty at the moment. And the goal here is that the system, not we, I didn't create it, but the system is created to allow limited access to your retirement savings. So you still can stay employed, you can still stay a contributing member towards your retirement fund, and you can still protect the majority of your retirement pool, but it makes provision for genuine emergencies. What that means for you is that you can access a little bit of that money now and still keep some money for later. And what we've seen, and this is why I believe it's a behavioral problem, cashing money out of a retirement fund or accessing the two-pot, more than a financial problem. And I'll speak of a client that I worked with that had this situation. So successful corporate ladder climber, worked at 4 major banks in South Africa in his career, and every 7 to 10 years he would change from the red bank to the green bank to the blue bank, and he'd move around. And I met him when he was 58 years of age, 2 years away from compulsory retirement from the bank he was at, because retirement age was 60 at that bank. And we met together in the canteen at that bank's head office. And bear in mind, he's 2 years away, so that's a fantastic time. We're having this conversation, and it's not 2 days away from retirement. And he shows me his pension statement. And the sad reality is his pension statement shows a balance of just short of R1 million. It was about 990,000 Rand. And he says, Terence, this is all the money I've got. I said, perfect, at the bank, this is your pension. Great, what about your other investments? Literally no other money. He had 30 or 40,000 Rand in a savings account in the bank, and that was it. Now, 60, in my opinion, is still very young. I think the banks could have kept him on much longer, and I think most of us want to work past 60 because retirement is a financial decision, not an age decision. However, I asked him, but what about your employment history? Where's your savings been, your investments? Give me some information, give me some insights, because I want to understand the person I'm dealing with more than so their money. And he explained to me that he's been a teller, he's been a service consultant, he's worked in the front of the bank, the back of the bank, he's now in management at the bank, middle management. The catch is every time he left, he would transfer his bond to the new bank, because you get staff rates and you get to save interest, which is, yes, love that idea. But every time he did this, he cashed out his pension fund because in his head, he was paying off his bond. When I met him at age 58, he still had a significant bond with a significant bond payment. So in his nearly 40-year career, he has R1 million pension fund and a bond. So his technique didn't quite pan out. And this I'll come to again later, why retirement funding shouldn't be used for debt. Because all the words I'm using in this talk today is retirement funding. Ladies and gentlemen, retirement money isn't pay off the bond money. It isn't put kids through university money. It isn't I need to replace my car money. It is money for the day I decide I no longer want to exchange my time for money and I want my investments to look after me. Now, a rule of thumb, and it's good, it does sometimes have a few errors, but we have this thing called the 4% rule. And loosely what it means or alludes to is if you draw out as an income 4% of your investment in assets, your retirement fund should last you into perpetuity. So if you take this gentleman, he had 1 million rand, that is approximately 40,000 rand a year, or a little under 4 grand a month. His bond installment was nearly 8 grand, double that. Plus he has medical aid. Plus he'd have to pay municipal rates and taxes, water and lights. He'd have to pay his medical aid. His lifestyle was higher than his investable assets that we could make use of. And sadly, what has happened over the years is he has been drawing more and more capital out of his investment pot, and it hasn't grown. And that's now one of the things that the two-pot system wants to protect us from ourselves, is that we preserve money when we change employers. So what does this new system look like? And I alluded to the fact that it's actually 3 pots. Because ladies and gentlemen, your retirement funding as at the last day of August 2024 is called your vested pots. The rules of that game, the rules of that pot, the rules of the system stay as they are. So that's what I mentioned before, is 1/3 and 2/3, and when you resign you could cash out. That is still there. And let me show you it. There is our vested pot. So how does the new system work from the 1st of September 2024? Your money goes in, whether that's you or your employer, tax deduction. So once again, SARS rewards us for making provision for our retirement. But now what is different? No money goes in the vested pot. Your funds are split. 2/3 goes into the retirement component or the retirement pot, and 1/3 goes into the savings pot. And on the 1st of September 2024, if your vested pot had enough capital in there, 30,000 Rand was allocated to the savings pot. So what that means is on the 1st of September 2024, whatever balance was here is still there, still growing, still invested. 30 grand was moved over to the savings pot. Now all 3 pots can be invested in the same portfolios and have the same rate of return and the same growth. It doesn't mean that because it's a savings pot, it earns less. Okay, they can all grow nicely. So what happened now is you have this savings component where 30 grand or 10% of what was in here, the lesser of, was allocated, which was made available. And if you heard in the news and if you had a look, billions and billions, and I sound like Donald Trump, don't I? Billions and billions of rands was cashed out of the system. Okay, because it's available and people made use of it. And I'll come to it in a moment as to why, because I've spoken to a few financial journalists and a few administrators to understand this. But what happens today and since the 1st of September 2024, if for instance there's a 3,000 Rand a month contribution going in, 1,000 Rand a month goes to your savings, 2,000 Rand a month goes to your retirement component. And once a year, you can take out money from your savings component. Minimum is 2,000 Rand. The maximum now is whatever's in there. However, it is taxed at your gross income, at your marginal rate. And this is the big caution. I hope this is showing up nicely. And then you have your retirement component, and that is 2/3 of the money. And here's no access until death or retirement. So now we are protecting your retirement income one day. And I think that is fantastic. What happens now? You want to withdraw from your retirement pot. How would that look? Firstly, I actually should have put this the first step, is chat to your financial planner. And ladies and gentlemen, we don't want to stop you. That's not what we're here for. We just want to engage in a conversation to help you understand what's going to happen, why it has this impact, and what it needs. And I'm going to run through some of that in a couple of slides to come. But should you want to exit, and whether it's through your employer, so a pension fund or a provident fund, or you want to cash out from a retirement annuity, we make application to the fund. So there's paperwork to be done. Some have a WhatsApp line. There's a call center. Some is done online as well. And the fund is now going to ask SARS for something called a tax directive. And this was where I said to you that gross tax, gross income, and it's taxed at your marginal rate. That's where this applies. So they are going to say to SARS, listen, Terence wants money from his portfolio. How much do we tax him? Ladies and gentlemen, the administrator and SARS are going to deduct first. Meaning some administrators charge around about 350 Rand for this, some a little more, a little less. And SARS gets their piece of the pie. Much like our pay slips, SARS gets the first piece of the pie, we get what's left. And then the net amount is deposited in your account. And the processing times vary, on average 7 to 30 days, depending on the situation. Sadly, what we have seen is scams have come up. Please be careful. Your administrator, your pension fund, your provident fund, your public sector fund, your government employees pension fund, all these port funds, they are never going to contact you and go, hi Terence, you've got money in your savings pot, it's 50,000 Rand, do you want it? They will never do that. If you ever get messages like that, treat it as a scam. Contact the official call center number, contact your financial planner, discuss it with them. Okay. Please don't act on that. Now, let me show you what this means when we say taxes deducted first and fees, and you get what's left. This slide shows you a person taking out 30,000 Rand. And if your income, you earn 15,000 Rand a month, so that's 180 grand a year, you fall in here in this first tax bracket on top. Let's see if I can get my little pen to work again. So there you are, you're a 15,000 Rand a month income earner, you're at the 18% taxable income, you withdraw 30 grand, 5,400 Rand will go to SARS. Now you're a 40,000 Rand a month income earner. So that's 480,000 Rand a year, you'll fall here. You've withdrawn your 30,000 Rand, and nearly 10,000 Rand is going to get deducted for tax and fees, and you'll get about 20 grand. You're going to lose about a third, as it says here. Okay. Ladies and gentlemen, understand the consequences of that decision from a tax perspective. For those that potentially are in the highest income tax bracket, so earning more than 1.8 million Rand a year, 45% of that goes off to SARS and fees. Okay. Now I understand situations crop up. You may need capital. You may need funding to help you in those situations. And I have a couple of solutions I want to run past you as we get closer to the end of the slides. But this is what it looks like. Now, our good Reserve Bank, National Treasury Governor has now just changed this whole table for me because he adjusted the income table today. So ladies and gentlemen, there's now been adjustment on our income tax rates effective from Monday. So we're all going to go home with a little bit more money, hopefully. If you're not sure, reach out to your CFP and find out what that means. So when you are going to withdraw, have the conversation. Know what that means. Understand also that depending on the amount that you withdraw, because it might not be 30 grand, because maybe you do this in 3 years' time, 5 years' time, 10 years' time. Maybe it's 100,000 rand. It might change your tax bracket. If you're the 40,000 rand a month income earner, and like I mentioned, you are in the tax brackets over here, there's 375, 112. So that's 480,000 rand a year. But you withdraw 100,000 rand from your savings pot. It's now going to push you into this tax bracket. So understand the cost to make these withdrawals. My recommendation when you talk to your CFP, and you have to take this out, first ask your administrator for a tax simulation certificate. It takes 2 or 3 days, most of them, and they will show you then what that could be for you. Big cautionary here. If you are behind in your taxes, SARS says, thanks very much for letting us know you have some money. And they may take even more than those tables. And there has been cases now that has happened in the last 18 months since this came to be, where people actually never even got their withdrawal. The full 30,000 rand was kept by SARS because they were behind. Okay. So if you owe SARS money, the tax directive that is issued could mean extra deductions. And it may mean you get even less or nothing is paid out to you. Okay. So we've got to be very, very careful when doing this. So again, and I'm going to drive it hard, always please talk to your CFP. Let us help you work this out. Let us help you navigate this situation. Let us see what we can do to maybe reduce the amount or prevent it entirely. Because ladies and gentlemen, what that means now is that this savings pot money is getting taxed at a rate of between 18 and 45%. Now, if you don't make use of your savings pot and you come to retirement time, okay, and the previous system, this is what it looks like, is that the first 550,000 rand is tax-free. And then it's 18, 27, and 36%. It doesn't even hit 45. So tax has a massive role to play when planning for your retirement, so pre-retirement age, when that event might be, and post-retirement age. And we need to be cognizant of the consequences of our decision. So have a thinking partner and have someone you can discuss that with, that is independent from your funds. Sadly, and I hope I don't offend any HR practitioners who may be watching, but I've seen many just give forms because I get their forms and I get the emails. They don't understand the tax system very well, and they often give advice that I wouldn't recommend following. So make sure you make an informed decision. Let me jump into a real life example at this stage, and let me show you something that ties this all up, hopefully. So I now have a 30-year-old person. They're employed. They belong to a pension fund at their company, and it doesn't matter if this is a pension, provident, or retirement annuity. Same rules apply. And their monthly salary before deductions is 30,000 rand a month. Now, I've gone ahead and assumed that they are contributing 7.5% of their salary, and their employer, bless them, are matching. So 15% is going into a retirement fund. So firstly, you've just doubled your money. You've doubled your investment amount because because you're only putting in 7.5, but your employer is matching you. If you have a matching employer, as much as you can afford to put in, keep going because it's free money. So what we've got here is a situation where 4,500 Rand a month is being invested in this retirement fund. And it's now February 2026. And this individual would like to withdraw 50,000 Rand. That's made up of that 30 grand that went there originally, and then some of the contributions they've been putting in and some growth. And they want to cash out 50 grand. So what does that look like, or what does that mean in a real life situation? And let's just see if I can get my little pen again. So they want to take out 50 grand. They fall in the 31% tax bracket. There's my frightened kitty cat. Whoa! After fees by this administrator and tax, they're only going to get 34,000 Rand. Now, if they didn't do this at the age of 30, they didn't take out this 50K, that could have been worth 1.4 million at retirement age. Now, not all is lost, ladies and gentlemen, because you can either work another 4 years nearly, 41 months to make that back, or you can increase your monthly contributions by just 259 Rand to catch up. So not all is lost, and you can make provisions, but in most situations you wouldn't get this kind of data. You wouldn't know these numbers. You wouldn't be able to make an informed decision. And that's the whole point of working with a CFP, that we want to help you make those decisions. So often now I said to you, why do people cash out? And it's a line item on the form because it's for statistics and market research, data analysis. And the vast majority, all right, and it was close on 70% of people that cashed out from their savings pot are taking money out of their retirement funding to pay off debt. And from my experience in dealing with families for nearly 20 years, I understand it, and that's what we hear often. And Thandi, I saw your hand. We will come to questions at the end, I do promise. And what's interesting is we want to pay off debt, and we have this perception that, well, I must take my retirement funds out now because I'll pay off my debt because then I'll be better off. Okay, can I please show you some numbers? And because we're financial planners, right? But I deal with families, not numbers. I want to know people before the numbers, but the numbers matter. So we now have this 34,000 Rand that is available to us, that we got out net of our tax and fees. Now on the weekend, when I was finalizing my slides for this presentation today, I did some research on personal loans. Now I don't have one. I did have one. We've all probably had one. I had one in my early 20s. And one of the banks, and I'm not going to mention who, but they became the largest bank in South Africa by banked customers. So you might be aware of them. And on their website, and I just want to read it off my notes here, their personal loan interest rates range from 12.25% per annum to 27.75% per annum. That's the interest they levy. So I just went roughly in the middle and I said, let's say you're at 18.5, and it's a 2-year left on your personal loan. Okay, so you can use this money, that's how much you owe on the loan, at that interest rate, and you're going to pay it off. So I get it. It sounds like a good decision, right? But we know that by doing so, we're losing a 1.4 million Rand income generating asset. And either we have to put in 259 Rand a month more from today until age 65 to catch up. Or if we don't do this, we're going to work for another 41 months. So instead of retiring at 65, we're now going to retire at roughly 69. Well, not something I want to be doing. Let me show you. So you've taken out the 34 grand to pay off your interest at 18% for 2 years. You've saved yourself 7,000 bucks in interest. Well done. But what you did was you paid, because you took out 50,000 Rand from your savings pot, you paid 15,500 Rand in tax and 350 Rand in fees. You actually paid 15,800 Rand. Is it better to withdraw from your savings pot or pay off your debts? I'll leave that decision up to you and in your consultation with your certified financial planner. But please make sure you make informed decisions. And informed decisions, ladies and gentlemen, is not talking to your mate around the braai. It's not while drinking kombucha. It's not reading Facebook groups and TikTok videos. It's talking to a licensed, registered, board certified financial planning professional. That's where you must get your advice from. So, when might it be a good idea to withdraw from your savings pot? I'll use the traffic light scenario. It's quite common. The green situation is there's no other alternative. Like literally, the proverbial has hit the fan, Murphy has come knocking, and you are in trouble. And if you don't do it, there's going to be dire consequences. So such as essential medical costs, preventing eviction, keeping basic transport to work, not Uber Black, doesn't count. So potentially the right reasons to take money out. Be cautious. You have alternatives. You could cut spending. Ladies and gentlemen, stop the streaming services. Ladies and gentlemen, eat out a little less. Get Uber Eats a little less. Restructure debt. Use your emergency fund. I'm going to come to that. Maybe negotiate payment options. Again, so we can possibly fix, but it's a bit of work, right? Never take out your savings pot for things that are not genuine emergencies. Black Friday sales? Discounts going on holiday? Paying off that debt without adjusting your budget. And that's where I say this is a behavioral decision, not a financial decision. So if you are going to withdraw, have a plan. Funny thing, we're called certified financial planners for a reason. We're going to help you plan. Decide and structure and plan on how you're going to rebuild that. And again, I said we love our rule of thumb, or we love guidelines because they're nice and easy to follow. Just because you can take out of your savings pot does not mean you should. Be intentional, be aware, make an informed financial decision. To try and prevent yourself from having to go into your savings pot, you hear the financial profession and everyone in it talking about this emergency fund. And some people I talked to go, but Terence, I've never had an emergency. I said, not yet. And I've had an emergency. I live in Johannesburg, and Johannesburg has more potholes than roads. And I hit such a pothole, and I needed 7,000 Rand for new tires. And yes, I said tires, because you can't replace one, you have to replace two. And then there's wheel alignment and balancing and other costs. That's why you have an emergency fund. You need to build one up over time. And this again is a personal situation, but the rule of thumb, 3 to 6 months of essential living costs must be built up. And I say essential, it's to keep the roof over your head, food on the table, you going to work, kids going to school. It is not takeaways, it's not getting your hair done, it's not fancy outings. We can change those. And start small. I know budgets are tight, I know cash flow is tight. And when I say start small, even literally 100 Rand. Make it a goal to build up that emergency fund. The way to start that, like I say, even if it's 100 Rand, but go and look at the last 3 to 6 months of your bank statements. Highlight physically, like the old school, I did grow up with pen and paper, which was wonderful, and a highlighter. Highlight what is essential. Come up with a figure. And I'd say 3 to 6 months because stuff comes and goes. It was now holidays in December. Kids went back to school in January. There was a few anomalies. But get your average. See your average of what does it cost to put food on the table, keep a roof over your head, pay your medical aid, pay your insurance, things like that. Start building up towards that emergency fund. Now, it might feel like a massive mountain. I get it. Strive for even a week worth of those expenses. Strive to even hit 10,000 Rand. Have some sort of buffer, some sort of safety net. This is your protection mechanism. It's like putting on your safety belt when you get in the car. How are you going to protect yourself? Now, this is self-insurance. You're protecting yourself. Please don't go and invest this in the market. Please don't go and look for schemes that guarantee you returns. Ladies and gentlemen, this should be boring. Okay, boring is safe. This needs to be in a safe savings account at your bank, and this is where the catch comes, that you could access immediately, but you don't. Please don't use a 32-day account, because in my situation, I'm now on the side of the road, no puncture in my tire, can't drive. Do I just leave the car there for 32 days? No, right. I need the money. So let's make sure we do that. And if we have to use it like I did, I start topping it back up again. 500 Rand a month, 600 Rand a month for a year, bam, put back in my 7,000 Rand. Good to go. Here's why your emergency fund matters. One, hopefully you won't need to access your two-pot. It'll keep you calm when trouble comes. When the storms are looming in the horizon, you know you're safe. And it could mean protecting you as well from taking out one of those expensive personal loans. We don't want that. So these are the mistakes I've alluded to as you've been going. Just because you can doesn't mean you should. Even though you are able or allowed within the law to withdraw every year doesn't mean you should do it. Okay, still think of your savings component as long-term. Let's change habits and behaviors versus putting our hands in the pot and taking the money out. Many forget that there are tax fees and deductions, and some treat that retirement savings like, well, I can do this every year, might as well. And then the big one, please watch out for fraud. We don't want that to happen. So only withdraw if it means that if you don't withdraw, it could be even a worse outcome for you. So work out what you need, do the calculations, have a plan, make sure you're intentional about it, chat to us as financial planners, and understand the consequences. One more quick real-life example, and then we're going to jump into Q&A. Here's a different illustration of what I tried to show earlier, or somewhat different. Again, 30,000 Rand withdrawal. Over there, 30 grand withdrawal. And what this is showing is, again, a 31% tax rate at a 10% return, but the different years to retirement. Okay. So same tax applies, they get out 20,000 bucks. But if you're 10 years away from retirement, that's just cost you 77 grand. Or to replace it, we need to put in 45 grand. 15 years away and 20 years away, you can see the cost, that asset that you have just lost by cashing out today. So if you have to, once again, make it an informed decision. I'm going to jump into questions now, and hopefully we've got quite a few. I want to leave this slide with you as you think of your questions. Although you can, please don't. Please be careful. Please be aware. Please be intentional. And the biggest one I'd like you to be aware of is where to source your financial information and where to get your advice. National Treasury, search for them on their website, amazing updates and questions and answers. Our regulator, the FSCA, SARS puts out information. Talk to your administrator, the company that manages your pension fund, your provident fund, or your retirement annuity. And make use of the FPI My Money 123 website, as well as your CFP, because we're here to help you with it so that you can make an informed decision, not one made on emotion. So always do your own research, always trust but verify. And here is the website address that you can make use of to find a financial planner and have a conversation about the two-pot system, about your retirement planning, about debt management, cash flow, everything I've discussed today, my fellow colleagues around the country are here and willing and able to help you make wise and informed financial decisions. Thank you very much for your time. I'm going to stop sharing the presentation and I'm going to answer a couple of questions. Rihanna, what do we have for us?
Well, Terence, at the moment, we've only got somebody asking for the PowerPoint presentation. But could I just tell them that the recording will be available on the FPI's YouTube channel, and I have already posted it in the chat. So watch out for it. It will be available for you to go and review at your leisure. Is there anybody? There was a hand up earlier. Is there a question that you want to post? Let's see.
Anyone have any questions?
Terence, and maybe let me start. Maybe you have answered this, but maybe you can just answer me on that. Can you really catch up on what you have lost if you make withdrawals, especially if you make regular withdrawals before you actually go on retirement?
Rihanna, yes, you can if you're going to match that withdrawal with the behavioral change. So it is possible, and like that calculation I had up on screen earlier, it is possible. But sadly, what we see is there's the financial difficulty and pressure on the budget, on the cash flow. So what happens is someone takes that money out to pay off the personal loan to free up that 1,000 Rand a month they were putting in the personal loan. And that now is just consumed. It's not put back into the system, which was only 259 Rand that they needed to. I've had now actually a review session with a client this morning. He stopped his retirement funding for 12 months, had business restructures, couldn't afford it, etc. And he thought, well, he can just switch it back on, the same amount he was doing a year ago. And when I showed him the consequence of that year out of contributions and because of growth, etc., he has to increase what he was doing by nearly 13% from a contribution perspective. So it's possible, and it can hurt because it's going to have an impact on your cash flow. And the longer you wait, the even more expensive it will become.
Absolutely. And like you have said, it is it's not a financial problem, it's a what did you call it? It's a behavioral problem, and I can attest for that. I mean, you pay off something, and as the money becomes available, it just gets added into the budget, and you start spending it on something new, something else, instead of like you said, sit with a financial planner professional, go through your budget and get rid of that debt and have your emergency fund for those tires if you need them, and save your money that was earmarked for your retirement for that purpose, because we're all going to need that in retirement. Cost when you retire increases, it doesn't decrease, because all of a sudden your health deteriorates, your medical expenses become more. So you actually do need every single rand that you put into your retirement fund at retirement. And I'm happy to say we've got a question. Camden says, so what is the point of having retirement annuity funds if you can withdraw it so often? Isn't the point of it to be for your retirement? What did we say?
We're aligned, but I also understand reality. I mean, I'm sitting here today going, I'm now contributing well to my retirement annuities. Not enough, because I'm catching up years that I never did. We've all made financial decisions we regret, but we made the best decision we could with the information we had at the time and maybe the pressures we had at the time. Cameron, what the system is trying to do here is protect us for later. So at least now, 66% of your money is saved so that when you hit retirement, there's at least some money. What we've seen, Camden, in the situations is where people cash these out, they leave jobs every 5, 6, 7 years, and they're always starting from zero. at least now we should have some preservation happening, and it should start protecting future generations.
Excellent. Then we've got a question from Rivers. He says, "Hi Terence, I'm asking the question on behalf of the public. If a client is over the age of 55 and has not retired, would his or her savings pot be taxed under the retirement tax table or the marginal tax table if he or she withdraws from the savings pot? He or she was not aged 55 or over on the 1st of September 2024.
That would go as the retirement pot. So retirement tables, I mean. So you would still have your vested rights, and then 1/3 is available to you as well as your savings pot. And the retirement tax tables would apply in that situation. And then the rest would go into an annuity type product, and there's various options available, and that we assess at the time to see what is best for that retiree.
Rubis, I hope that answered your question on behalf of the public. The next one, Bailey is asking, did I miss where you mentioned why your house is not an asset? I don't know whether you want to answer it at this point or do you want to keep it for another webinar?
Bailey, I didn't say why. That's another discussion and another webinar. And it's also a very hotly debated topic, because some agree and some disagree that your home is an asset. I'll leave it with hopefully not too many shots being fired, but your home, you have to pay to live. It costs you. It doesn't put money in your pocket. And yes, even though you bought it for R1 million and you sell it for R3 million 20 years later, and we work out the time value of money and the cost to have it, I still would argue, and there's exceptions, there's always an exception to the rule, but the home you live in is an emotional decision, it's a behavioral decision. It's not necessarily an asset.
Can I take it one step further? What if I have bought a property which I'm not living in, so I'm renting it out? Would you consider that to be, number one, an asset, and number two, a way of having extra income at retirement?
Yes. So one that now depends now also is your income less costs and tax still positive? So is that a cash flow positive property? And the value of that property growing over time. Now there's many successful property investors. I have a couple of clients and other financial planners I know as well. So absolutely. And again, it's going to depend on what is your risk appetite. How does it fit into your portfolio? Understand the potential lack of liquidity, because fixed property can take a while to sell. There could be periods where you don't have a tenant, so you're not earning. So there's no rental income, or if it was an investment, there's no dividends or capital growth. So yes, we've got to play that up. What I see a lot with my retirees who have had a multiple rental property portfolio is they reduce that over time, because they don't want to be 70, 80 years old and having to deal with a burst geyser. And I know you can get agents, so that's why and this is why I love financial planning, is there is no one answer. It all depends. And we've got to assess it on each person.
Perfect. Let's see, another question from Edward. What percentage of your income should be allowed towards retirement? I've heard some wild takes, even up to 35%. I guess it depends on the starting point.
Edwin, it's how long is a piece of string? Okay, so we should actually do some calculations. Now, I also understand to try and say, well, I'm 30 years old today, and Edwin, I don't know if you are, but that was the examples I had in my presentation, and I'm going to retire at 65. Who knows where you're going to be in 35 years' time? Who knows what the cost of living is? So we make those assumptions today, and we try and build you a cash flow model, a retirement provision for that. The sooner you start, the smaller generally your contribution needs to be to meet it. From a tax perspective, and please let's not build a retirement portfolio or plan around tax. It is an important element, but it's not the reason why. But you can contribute 27.5% of your income to a retirement funding vehicle, pension, provident, or RA, and allow that full amount as a tax deduction, now increased from 350 to 430,000 Rand a year from Monday. So we can look at that. Edwin, I will end off by going, I've had some clients where we do their retirement planning, and I've got a lady now who's 58, she's leaving a bank at 63, and she needs to allocate 57% of her income to meet her retirement goals. And that's because she didn't invest enough, she cashed out pension monies, and what she needs to survive is just, there's not enough asset to provide the cash flow. So it's very much a case-by-case basis.
All right. Is there any more questions? I'm not seeing anything in the chat. If there's nothing, Terence, I'm going to give you the last word, and then we will end the session.
Please remember to visit the FPI mymoney123.co.za website, chat to a CFP, help them make informed financial decisions. Do that sooner rather than later, because years fly by in a second. And I wish you all a successful, wealthy, and wonderful retirement one day.
Thank you, Terence, and thank you from the FPI side for your time and for this wonderful presentation. I trust that the guys online found it informative, and they've taken quite a number of tips away from this presentation. Please be on the lookout for the next webinar that will be in March. There's actually 3, one on the 16th, one on the 18th, and one on the 25th of March. See you there. Thank you so much, guys. Have a lovely afternoon.